Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. Now it's time we talked about the 18-year property cycle again. Because one, you keep asking us what is happening with the 18-year cycle. But two, things have changed. Or have they? Because Rob and I have a difference of opinions with what is happening. Who is right? Well, listen and you can decide.
Welcome to the Property Podcast, where we take time out from spending all day, every day, embedded deeply in the property market and bring you some of our learnings and observations for free. Last week, we brought you a view on what's happening in the market right now that's different from what you'll hear anywhere else. And today, we're looking at what comes next. It's so important to stay informed at the moment because there's so much going on. So do make sure you're following the show on your favourite podcasting app, whether that's Apple Podcasts or Spotify. Dead easy and free to give us a follow. And make sure you stick around to the end of today's episode, where we're going to be giving you a resource to help you navigate your summer holidays.
So it's time for our news story of the week now, and really interesting data coming from the BBC website. Now, the BBC's headline is "Renters Compete with 20 Others in Battle to Find Home." And this was a report put together for the BBC by Rightmove. Now, this is something that we've been talking about quite a bit on the podcast recently, about how strong rental demand is and how that's pushing up rents all the time. And this data very much reflects that and goes into even more detail. It says that every single area that Rightmove looked at has tripled in demand since 2019, at least tripled. Some areas like the Northwest, for example, have seen demand much, much higher than that. And we've talked about the rental demand in Manchester in particular recently and how extreme that is. Now, of course, when you have a supply and demand imbalance like we have with rent right now, that means that rents are going up. And there's also reported that people are actually offering above the asking price for rents. So similar to when you see a property price boom, where people will put bids in and then go above the asking price, that is happening in the world of rentals right now. There's mixed feelings on this, of course, because, okay, as a landlord, your mortgages are going up or may start to go up as they come out their fixed periods, and this will offset those mortgages. But for tenants, of course, this isn't a great experience. They're having to fight to find a property, and the prices are going up and up and up. It's not a perfect world. It's not a perfect situation. For landlords, it means that those rent rises and that quick turnaround on void periods means that you aren't being as hurt as much as you would have been with mortgage rates going up. This is not something that's just going to disappear quickly. So we're going to keep an eye on this. We're going to keep reporting on it. And of course, the place to find out what is happening on all things rents is the Property Podcast. And we'll bring you more on this in the next market update.
Exciting times, because in the next few weeks, we are having a meetup in London. Now, this is exclusively for Property Hub Select members. If you don't know what a Property Hub Select is, you can go to propertyhub.net/select. But Rob, this is going to be so cool. We've not done something like this for such a long time. We've never done it with a select group of people, and we've never put as much thought and intentionality into an event as we have before. We've been thinking a lot about the events that we enjoy going to and how to make it as valuable and enjoyable as possible. So I think this is going to be a great evening, and what a great time to have it as well. There's so much going on in the market, so much to talk about, and so many experiences to share.
Yeah, I'm excited. I'm nervous, Rob. Not done these for a long time now, but we've put so much effort into getting this right, and I know it's going to be awesome. And we're going to be both there as well, which is unusual. Us both at the same event. Often we kind of split ourselves up to kind of go different places and cover more ground, but we'll be both there. So really looking forward to that. There might be still time for you to sign up, depending on when you listen to this. But if you miss it, don't worry, because we will do future events as well. But to get in for this one, go to propertyhub.net/select. We are onboarding 50 people a month at the moment because we don't want to overload it. You know, suddenly we're doing events with hundreds and hundreds of people. That'll be a bit crazy. So bit by bit, we'll just bring people in. But we'll bring another 50 in this month. So go to propertyhub.net/select to find out more. Now, last week on the Property Podcast, we put a case forward to you that the property market is crashing or has crashed. And that is big news. Not been covered as much as we'd like, but we are doing our best to get the information out there. If you've not listened to last week's episode, I would put it down as a must listen. Please go and listen to that episode before you pick this one up. But off the back of that, we've put forward a case that the property market is silently crashing. What does that mean for the 18-year property cycle? The 18-year property cycle is something that Rob and I have talked about a lot over the last few years. And it's been one of the most popular topics that we've ever covered. And we constantly get asked the question, where are we in the 18-year property cycle? What is happening to the 18-year property cycle? But Rob, before we get into all that, answer those questions and more, for those people who are new to the podcast, let's give them a quick overview of what the 18-year property cycle is.
Yeah, this is going to be a really quick overview, so do go search the podcast archives, search the YouTube channel, there's loads more on this. But in the broadest possible terms, the concept of the 18-year property cycle is if you go back a couple of hundred years, you see something predictable playing out again and again. So you start from a point where property prices have just collapsed. They then bump along the bottom for 4 years, not doing very much at all. Then some confidence returns and prices spend 7 years gradually picking up again. At that point, you get a mid-cycle dip, so property prices pause and come down a little bit. And that sets you up for the final part of the cycle, 7 years of property prices growing more aggressively, including, in the last 2 or 3 years, property prices growing really fast. And of course, you don't need to know about the 18-year property cycle to know that property prices are growing really fast and everyone's getting carried away. That's probably setting you up for another crash. And that's exactly what happens. And at that point, the cycle repeats again. So it's an 18-year pattern. You can see it going back a long way. And in the past, we found this useful. For example, cast your mind back to 2016 and Brexit. There was so much fear and uncertainty around that time and lots of talk that property prices were going to crash. But we used the 18-year cycle to look at that and go, well, no, the current cycle only started in 2008, 2009. Therefore, we're nowhere near that crash. And that enabled us and the people who listened to us to keep on buying through that period and have been very well rewarded ever since. So we've personally had value from the 18-year property cycle. And it is, as you said, Rob, one of the most popular concepts we've ever spoken about because it gives you this beautiful idea that property prices can be predictable. You can see into the future. You can buy at the right times. You can avoid buying at the wrong times. This is what everyone wants. And for quite a long time, we were fully bought into this. We were using it. It seemed to be playing out perfectly. But I think it's fair to say that recently some doubts have been creeping in.
Well, yes, it was all on track. You know, we were able to make decisions based on the 18-year property cycle. We had faith in it. And then the world changed. Remember COVID? I'm sure you remember COVID. And when COVID hit, it completely disrupted the 18-year property cycle. And the boom phase that we were expecting sort of weakly played out, but didn't really play out. And then we've been dealing with the after effects of COVID from a financial point of view, with rampant inflation because of all the excess money that came into the system around when COVID was playing out to keep us all afloat. And things have just got off track. Right now, we should be nearing the end of the cycle. We should be in the middle of a boom phase. We should have been enjoying that boom phase for the last few years. That hasn't happened. So what does it mean? Today, we're going to lay out a few different viewpoints. I've got two possibles on what I think has happened with the 18-year property cycle. And Rob, feel free to challenge them, because I will be challenging yours, because you have a third scenario of what could be playing out. And I am going to lay out the first one today to say that my first of two is that it's broken. The 18-year property cycle has not worked this time around. And that's because the last time it didn't work was around the Second World War. And we've had our war. COVID was a war. It was a different war, but COVID was a war. The world came to a halt. There was a tremendous amount of fear. The economy was on its knees. We had to do a lot to make sure the economy didn't collapse. And with a wartime scenario, COVID, as we all know, lasted a few years, that was our modern day Second World War. I'm not trying to say it was worse or better or anything like that. I'm not going to get into any of that nonsense. But it was a war for us, our modern world. And that has meant that the property cycle, the 18-year property cycle, is redundant. It's dead, and it will work again in the future. But we've had that war, and that's what broke it in the past, and that's what's broke it this time. So there you go, Rob. That's my first one I'm putting forward. What do you think?
I think there's a lot to be said for that because COVID disrupted so much and we are still living with so many of the effects, which is not surprising. The global economy is an unbelievably complex, emergent thing. And if you just turn it off, you can't expect to then turn it back on a year later and it just to pick up from where it was. Weird stuff will happen and it all needs to be worked through. So I fully buy into that. What I'm not so convinced by is that the argument that therefore it's all over. Because we believed in the 18-year property cycle in the first place for a reason, right? Like we looked at the evidence, we looked at the history, and we were convinced enough to adopt it as a model. And you have to look at the reason why it has this historical track record. It's driven by banks' lending behaviour and people's sentiment kind of intertwined. So you have these boom cycles, which I'd say are probably led by emotion, but then banks really feed into that. Banks love to lend. That's how they make their money. That's what they do. So they facilitate this. They get carried away. Therefore, people get more carried away. And up and up and up it goes. Then boom, confidence evaporates and you're back to the start again. Does COVID mean that that's not going to apply anymore in the future? I don't think so. So if option one involves writing off the 18-year property cycle forever, both now and in the future, I'm not on board with that.
No, I'm not saying that it's written off from now and forever. Just like World War II, it was written off because of World War II, and then it restarted again. What I can't tell you is when it'll restart if this plays out. That's what I can't say. But World War II disrupted the cycle, stopped it, but then it started back up again. And then it was a useful model to make reasonable predictions. But at the moment, I don't believe it's a useful model because where are we? Like, it's not working. If we go with option one, it's not worked. It's failed. So what do we do? Well, the last time it failed was World War II. So then you go, okay, well, you just write this particular cycle off. It nearly worked, but then we had COVID and it'll restart again in the future, at what point to be determined. But unfortunately, as a tool, it's not working right now. But Rob, before I get into my second option, maybe you want to counter that with what you believe may be happening.
Well, I think there's a case to be made that you can't say it's failed yet, because this cycle is due to run until 2026 if you base it purely off the 18 years. And the 18-year thing, by the way, has always been an average. So I don't think you could get to 2026. It hasn't happened to go, ha, the whole thing's wrong. 18 years is what you get when you go and average out all the cycles of the last couple of hundred years. So I think you could say it's too early to say that it has broken, it's failed. There could still be a boom ahead. There is time for it to happen. So for the purposes of this argument, I'm saying that 2020, all the COVID stuff, that was not a boom. That was property prices going up with the price of everything else going up because of inflation. Not a property boom, not driven by over-the-top bank lending, not driven by greed and all the rest of it. That at the moment, that's all working its way through. We've talked about how property prices in real terms are coming back down to where they were before all that happened and then beyond. That then sets us up for the boom. I know it's hard to imagine at the moment, but it could conceivably happen. And I know that doesn't give you much time, so you could have this boom running beyond 2026. You might not get a crash happening until 27, 28. If that is indeed how it played out, then the cycle, I think you'd still say, had worked. So I'm certainly not saying that is my firm belief that's what's going to happen, but I think it is a viable option that's worth discussing.
Okay, so my initial counter to that would be, and I'm sure some people are thinking this, is, well, are you just extending it until you could say it's worked? Like, it's just making it conveniently adapted to go, okay, well, let's just keep rolling it out because, yes, officially the cycle should end in 26, but we're 2 years away from that. And I know it's an average, but we should be in a boom phase right now, and we're not. So the boom phase may eventually happen, but let's say it happens in 4 years' time. We're in a boom phase. Has the 18-year property cycle worked then? Or has it failed? At what point would the market need to start booming for you to say, okay, it's worked, it's just been longer than average? When would that need to happen by?
It's a fair challenge. And in my answer, I'm going to hit on a point that I want to make later, which actually counts against the 18-year cycle, which is, I reckon you can give it 4 years leeway. And that kind of makes it not very useful in certain ways as a model to follow, as a predictive tool. I want to come back to that later. But I think you could give it 3-4 years if the pattern in the meantime has broadly held. If you know anything about our service, Property Hub Invest, it's probably that we secure you exclusive property deals at a discount. But I now make all my investments through Property Hub Invest, And what I value most is actually the time saving and having the care team on hand to deal with developers, mortgage brokers, solicitors, all the things that normally cause so much stress and take up so much headspace. Property investment will never be effortless, but having the expert team at Property Hub Invest makes it so much easier. If you're interested in finding out more about Property Hub Invest, just go to propertyhub.net/invest.
Okay, before we debate them all out and go with one or none of them, let me present my third option, which is it's working. It's working all fine. And this is quite different to my first option. I appreciate that. But you could say, well, it's just been a weak 18-year cycle. We did have some growth. We did have a mini boom phase. And now we are having a weak crash, or as we discussed last week, a silent property crash. And it's all played out a very weak cycle after what was, last time around, a very intense cycle. The last 18-year property cycle was arguably the most intense since the Second World War. The 70s as well, that cycle, that was a particularly strong cycle. But last one, I think most people would agree, was the most intense. And therefore, having a weaker cycle afterwards would make sense. And that is possibly what's played out here. We went through the correction, we saw some growth, we had a mid-cycle wobble, we saw some growth again, we had a boom for a very short period of time, maybe you could say it was a couple of years, and now we're having a very soft, because of inflation, crash. And if that has played out, then I can live with that, Rob, because the way things are going at the moment, if inflation just continues for a little bit, it would be back to 01 levels and beyond. And the second fastest period of growth we've ever seen in the property market was 01 to 06, when property prices doubled in 5 years. The quickest was 3 years in the 70s, but the second quickest was 01 to 06. And we're not far off to getting back to 01 prices. But the main point I'm trying to make here is we have had a cycle of sorts. It's broadly worked, although not perfectly. It's finished slightly early because it's an average, or it's finishing because we've still got inflation right now and prices will continue to fall in real terms for the short term. And then let's say we get inflation under control in the next 2 years, we start a new cycle. But because this one has been such a soft cycle, you would expect the next one to be a stronger one. I appreciate this one's a little left field, and I'm not sure how strongly I believe in it, but I think it's worth mentioning it because it could be what's played out. I can't say I'm fully behind this one and I truly believe this is what's happened, especially as I've presented that the pandemic is broken. So I've gone to the two extremes here, that it's broken and it's worked. But I could see how others would make this argument and could make this argument based on the information I've just given.
So looking at your two views together, does the future look any different under either of them? Under one, you're saying the cycle stopped, it didn't apply from that point onwards, and then it'll get started again at some point. The other one, you're saying, actually, it did play out. We had the cycle, it just brought the cycle to an end early, and now we're basically having the crash, and then we're into the next cycle. But whether you're saying the cycle worked or it didn't, are your views about the future any different, depending on which one of those you believe?
It's a great question, Rob, and I think we can broaden out to look at all of the scenarios that we played out, is to say, well, how do we know what's happened? So you've put forward that, well, if property prices start to boom in the next couple of years, then the 18-year property cycle has worked. And it's been a bit of a weird 18-year property cycle, but it has worked-ish. Right? It's kind of more worked than not. So that would be the evidence for your scenario playing out. I think for the scenario I've just laid out, that it has worked. You continue to see high inflation, maybe modest drops in property, or it's staying flat over the next year or so. And then inflation coming under control and property prices kind of just ticking along, not really going up or down. And we have very sort of bland years, sort of low growth, and low growth in real terms as well over the next however many years, which isn't a disaster. It's fine. Property prices have readjusted because of all the inflation that we've had. And on paper, the deals have got stronger. And we've seen loads of rental growth as well. So I would say for the second scenario to play out, you would go, okay, well, you continue to see what we're seeing this year for maybe another year. And then it would just go into more stable market conditions, that 4-year plateau where nothing really exciting happens in terms of growth or falls. That would need to play out for it to be the scenario 2 that the 18-year property cycle has worked. My first theory that the property cycle is broken, I don't think I can give you an answer. And that's quite convenient, I appreciate that. But if it's broken, it's broken, so I don't know what's coming next. So it could go up, it could go down, it could be stable, I don't know. Because it's broken, I don't know. And it's only when we start to see a cycle kick on again and we can see those 4 years of steadiness and so on that I'd say, okay, well then the property cycle may be back on track now. But the convenience of scenario 1 is because it's broken, I don't know when the restart is. So I can conveniently get myself out of giving you a scenario of what would need to happen there. But I think scenario 2, yes, I think it's clear what would need to happen for that to be correct.
This is all a bit of a problem, really, isn't it? I mean, in terms of the cycle actually being useful, because we've laid out 3 options. I think you could say they're all plausible to some degree. We might have our favourites, but there's no way of knowing today which is going to be the case. You can only really validate it with the benefit of hindsight. I think the easiest one to validate is my option, because for that you only need to wait a couple of years. So we're sitting here at the start of 2026 and prices are not moving and there's no sign of anything happening. I think my option has to be thrown out the window at that point. Clearly, I'm not going to say, just give it another 6 years, guys, we'll get there. Not going to happen. But for the options you've put forward, you're going to have to be waiting a long time to see, okay, well, have we restarted? When did we restart? What does this mean? How do we set all our dates in the future? And that, for me, hit a major issue with this whole thing, not just since COVID, but actually at any time, which is that you have to have a heck of a degree in faith in the model to do anything with it. And in all the years that we've been talking about the 18-year property cycle, how many people have you encountered to whom it's given a rock-solid conviction about what they should be doing at any given time? I could name a few. But how many questions have we had from people saying, well, what's happening in the cycle? Where are we in the cycle? Does the cycle still apply because of this, going all the way back to 2016? There's been hundreds. So regardless of which option turns out to be the case, is it useful anyway, given that when you're in the moment, it doesn't really seem to be helping? It's only with hindsight that you can go, oh, yeah, that's what was going on.
Here's the beautiful thing, right, Rob? At least in the short term, none of those scenarios change what I'm doing today. Because today I'm buying good properties in good areas for the long term. And if any of those cycles play out, that doesn't change things. If I start to form a belief in one of them, it may change how aggressive I act in a certain period of time, if I have the ability and means to be aggressive. But actually, unless I feel the market is on the verge of a complete collapse, which I don't believe it is at the moment, and none of those scenarios lay that out. The one is that we're in the middle of it. It's a silent crash. It's a very easy crash to deal with. Unless there is a huge crash in nominal prices, and I believe that's on the verge of happening, I don't change what I'm going to do. And because I don't believe that's going to happen, and none of these scenarios lay that out, for me, I just buy well in the areas I want, apply the monopoly strategy that I've been working on, that I talked about a few episodes back, worth a listen if you haven't listened to that one yet. But that is what I'm doing. That is my strategy. Unless an extreme market effect takes place where we see a huge aggressive boom, so therefore at some point an aggressive crash will follow, unless that happens, everything else is just game on. Let's carry on what I'm doing. Not that exciting. Just picking up good properties in good areas at good prices for the long term. Pretty vanilla. I'm pretty dull, aren't I?
Yeah, but investing, you don't win prizes for excitement. You get rewarded for results, and the way that you get results often looks pretty dull. But I think you've hit on something really important there, which is that I've been saying this for years. This isn't really anything new. But I think the most damaging part of the 18-year property cycle is the 18-year part, because it is only an average anyway, and because it anchors you to, should this be happening right now? And how long is it until such and such happens? I think by fixating on that, we try to get the 18-year cycle to do too much. But if we keep the insights that are at the core of it, which are around what Fred Harrison was talking about in the first place, which is about all the rewards of progress being capitalized into the land, which is about bank lending, which is about credit cycles and emotion and greed and fear and all that stuff. I think if we keep all that, but stop obsessing around the micro stages along the way and the timing of it, it can still provide a useful function, which is that it should be clear when you should be absolutely backing up the truck, buying everything you can possibly can. It should be clear when that's the case, And that's important because it will feel like that's absolutely not what you should be doing and no one else is doing that. But that's for a very narrow window of time. There's maybe 2 years out of the cycle when that's the case. It also tells you when you should absolutely not be buying and you should actually be offloading. And that, again, is not very often. That's a couple of years out of the whole cycle. And again, that's going to involve doing the opposite of what everyone else is doing. The rest of the time, it's neither of those. It's not a time when you should be going nuts. It's not a time when you should be trying to sell everything you possibly can. You're just sitting there doing your thing, steadily accumulating like we're doing now. And if you just hold on to that bit of the cycle, then maybe that's enough. And I think we clearly do, at heart, have some kind of faith in the underlying mechanics of the cycle because we're not freaking out right now. We're not looking at all the stuff in the press about how house prices are going to fall by whatever dramatic prediction someone said yesterday. Because at a fundamental level, we don't believe that's going to happen. Therefore, we can continue just doing our thing and not sitting there paralysed in fear and only going into the market when it's already booming, which is exactly the wrong time, which is what most people do. So I think what I'm saying here is we're expressing a lot of doubt about the cycle. We're struggling to pin any years on the cycle. We can't even agree on whether the cycle has ended or not. But maybe it doesn't matter. Maybe there's still enough of an insight at the core of it to help us out as investors.
Right, it's time for Hub Extra. And Rob, a blast from the past, because I seem to remember this being mentioned as a Hub Extra way back when. I mean, we're going years and years and years ago, and I don't even have this app on my phone anymore. So what is it, and why have you resurfaced it?
Yeah, Rob, it's time to reinstall Citymapper. And there's two reasons for me bringing it up now, apart from the fact it's summer and so people are more likely to be travelling. The first is that I've been travelling recently and was astonished by the number of cities it covers. It covers so many more cities than it did last time I looked, including some really niche ones. And in fact, I've been to a couple of cities where I could have been using Citymapper, but I didn't even think to look at it. Because there's no way it's going to include Malaga in Spain, but it does. And the second reason is that they've changed their model recently, and I can't remember the details of it, but you used to have to pay for premium access to get a whole load of features. They've now changed it, so you can do everything without paying. There's just some ads on there. So without paying, it's far more useful than it used to be. And when it comes to how reliable and useful it is, for London at least, I can't speak for anywhere else, it's far and away the best option. It is so much better than relying on Google Maps. So the fact that you can now do that in all these different cities and it doesn't cost you anything, there's just an ad at the bottom of the screen, I think that's a pretty compelling reason, Rob, to get it back on your phone.
Well, Rob, thanks to my super fast broadband, I've already downloaded it, opened it and started to take a look. So we better wrap this podcast up so I can go and play with some tech. So between now and then, you've got an app to play with. You can go and check out Property Hub Select at propertyhub.net/select. And you can also go and check out all the other good stuff we have on our socials. In fact, let's get a little quiz out there. What scenario do you think is playing out right now when it comes to the 18-year property cycle? We'll ask that question on our socials. We'll do a little bit of a poll. So whether it's Twitter, YouTube, LinkedIn, whatever your favourite type of social is, we've got you covered. Go and check out them all with Property Hub UK. We'll have a little vote there and we'll see which one wins. And of course, we'll all be winners next week because we have a market update episode and they are always super popular. So until then, take care, have fun. Bye-bye.
Bye-bye.